What up, young slumlords and ladies? This is Jake Lapp, and welcome to the Young Slumlords podcast, where me and Caleb Henshaw talk our shiz and hopefully help spark the idea for finding your financial independence in this paycheck-to-paycheck world.
What's going on, everybody? Welcome back. Welcome to episode 19 of the Young Slumlords podcast. We've got Jake Lapp here to my left. What's going on, man?
What's up, brother?
We got a little bit of a different show today. We just want to explain and run through some of the properties we walked through the other day and just kind of how crazy the market's been, just how expensive everything's been, the schemes that we kind of see going on. But I'll just jump it over to you, Jake. What have you been seeing in the market recently with these properties we just saw?
Just this last week, I put my first offer in that I didn't get the house on. So that was
nice.
That was, we all got to throw some offers in. And I didn't think they were bad offers, too. I went and I saw this triplex in Souderton. If anyone's following along or has their computer phone out or whatever, wants to see the property that we're talking about, it's 205 Green Street in Souderton. So it was a triplex, and it was listed for $495, which is like outrageous. You know what I mean? You see those numbers, or for me, I have a triplex. I paid $280 for it. Over a $200,000 difference. Like, it just didn't even. Normally, I wouldn't even look at it, but I was like, the front cover picture was just beautiful. Like that, the house itself was just like gorgeous. They really took care of the place. Really nice landscaping. The house was beautiful. So I looked through the pictures, and there was a 4-bed, 2-bath unit. So it was a side-by-side duplex in the front, a big garage in the back with a apartment on top of that. So that's the layout of the property. And the front building, the 1 unit's 4 beds, 2 baths. And I start walking through it, and it is just like exquisite. It has tons of character, lots of like really nice woodwork. It's got like the old character, but it's been updated and has like newer appliances, and it, just looks really nice. I go through the place. There's really not much I'm finding wrong with the place. It has separate heaters, oil, but the tenants pay their own oil. All the rents were below market, but both units in the front, I heard from a source that they were gonna be moving relatively soon, so I wasn't too concerned with the below market rent. But the market rent that I was calculating for these places, the 4.2, because of the condition it was in and the location and everything, like I don't think we'd have a hard time getting $2,000 a month for that 1 unit. The 2-bed, 1-bath next to it was really big and laid out nice. I think, for a 2.1, $1,500 for this one would be super reasonable as well. And then in the back, they had it listed as 5 garage bays, but facing the house was a huge garage bay, like a double wide door and like 10-foot ceilings, really tall, like could definitely be a mechanic shop. Like a car lift could go in there, and I think just that bay by itself could probably rent for $400 or $500 a month. Then 3 other bays of the garage that were all normal bays, 2 of them $100 a piece. I would all day rent like the 2 bays and the 1 big bay to 1 person for a discount, just to make things easier, less payments and stuff. And then the 3rd bay had the washer and dryer and the water hookup for the apartment, the 2-bed, 1-bath apartment on top of that, which the apartment on top is where we would live. It was the least nice out of all of them, so it would produce the least amount of income. I estimate that it would probably bring in close to $1,300 a month by the time we fix everything up and get out of there, but that's where we would live. So completely functional and rented out, I think it could produce close to $5,500 a month, which, based off the 1% rule that we've all heard, it's hitting that. Even being listed at $495, it's better than that. It's saying the house could be worth $550, which, is crazy. But so I really like the place, and with us living there, we'd still be bringing in $4,200 a month. So I sent all the numbers or the property to Dylan and at Cross Country, and he ran everything. He figured my down payment, my monthly expenses, and if I'm not mistaken, they were pretty close to 3,600 at asking. So for 4,200 a month coming in, us living there and paying 3,600 a month out, that's pretty good. Like it is like $600 in cash flow, and while we're living there, and then close to Close to 2,000 when we move out, which would be really good. And that situation was with my FHA loan. So I realized that was the kind of the most that I wanted to spend, would be what they were asking. So instead of since I'm working with the FHA loan, I think the down payment was going to be close to, I think 40 some. But then if I rolled my commission from being my own agent, it'd probably be close to 30 some. So that's with the FHA loan straight up. And then I wanted to know what the option was for a 203K loan. So Dylan ran the numbers on purchasing lower, like if we offered 420 and had to put, for any reason up to like 50 grand in, because there's a higher interest rate associated with the 203K loan than just the normal FHA. So they kind of balanced out. It was actually 420 purchase price and 30 grand worth in rehab. And again, like the reason why we'd even entertain that, like there definitely wasn't a rehab needed, but for the sake of the seller, giving them peace of mind, it's a pretty similar offer to just a conventional offer. So what I mean by that is, FHA inspections, they're going to come back and say, if you don't fix this, this, and this, we're not going to give a loan. You can't do it. If you do a 203K loan, you're assuming that responsibility, taking it from the seller, and now you get the budget to go do that stuff with a licensed contractor. So I put in, my first offer was $480,000 with an escalation clause up to $500,000 in increments of $3,000. So what that means is I put an offer for $480,000, someone puts in an offer for $490,000, I would go $3,000 higher than them automatically up to $500,000. My second offer was, like we said, the $420,000 203K loan. So that was pretty much a conventional offer. Sorry, with that first offer, we would be making the seller responsible for making sure everything passes with FHA. So like, here, I'll give you exactly what you're asking for, but make sure it passes all these guidelines. So still not a great offer, but the 420 is more like my conventional offer was 420. My third offer, which I never really structured how seller financing could be done, and I spent a lot of time and I went through the numbers and did an amortization chart, and I came up with, I saw the amount that I'd be paying in principal and interest on the 495 FHA, and it was around $2,500 a month. The other $1,100 was with the property taxes and insurance and everything. So just off of that principal and interest, I knew that I can afford those and my numbers would work the same at that principal and interest. So I kind of reverse engineered the math equation and was like, what would I need to offer at a 6% interest rate to get to $2,500 a month monthly payments? So the way that I structured it was purchase price $450,000, $40,000 down. So I'd give the seller $40,000. Then the seller would carry the loan for $410,000. So they would be acting as the bank. And with that being said, now they're the bank. They give me the deed. I give them a promissory note. And if I default on any payments, they get the house back and they keep the money that I gave them. So they have a lot of safety. And that's the same position that the banks are in. That's why they hold your deed. And that's why you don't own your house until you pay the bank back. But the way I structured it was a little different because not a lot of people want to necessarily wait 30 years to make their money back. So making these payments at a 30-year amortization, $2,500 a month, in 10 years, I put in an optional balloon payment. So in 10 years, I would have already paid them $290,000, and that's including the $40,000 that I put down, and then $2,500 a month for 10 years. So now they make $290,000, and now it's due. The balloon payment for the rest of the mortgage is due, and that with the principal that I already paid was like 333,000. So now you add the 333 to the 290 and it's, what's that, 620. So instead of making 495, they make 620. Of course, it takes 10 years instead of 30 days. But now they're not paying capital gains on 495. They're paying capital gains on 333. So they're actually making a lot more. They're bringing home a lot more money, and it's a lot safer. And, I think whenever I get to the point of selling, this is the way that I would sell because I think it just makes so much sense. What do you think, Caleb? What's your...
To expand on that, it just seems like the reason why banks are so successful nowadays is because mortgages are cash cows for them in the long run. They get so much money from interest giving out all these loans to all these individuals across the country. And if they're making as much money as they are from holding the loan, imagine if you could just make that money yourself holding the loan. It's pretty simple. When you look at it, there's money to be made from the interest and holding the loan for that long. You just can't, have your money up front right away.
Right. So I just think it's such a great way to do things. Of course, for us buying with low money down and encouraging people to buy with less money, this is such a great option.
People want their money right away to then get into bigger houses, bigger deals and stuff like that. So it can be kind of hard to sell unless, of course, you're talking someone who's, 80, 90 years old and has a whole portfolio of all these properties they've been holding. They don't want to pass them down to their kids because the kids don't want to deal with them. Then they're going to look at, promissory notes for all these buildings that they have to pay them over the next 20, 30 years every month.
So now,
to a trust or something like that.
Right. So now the kids, instead of having to deal with these properties, they're just getting a check when they pass on or however they set things up. You can set those up in the trust so that your kid's just getting a monthly check from the buyer. And if the buyer defaults...
or it's a savings account for college or something like that, where it's you got all these grandkids and then all of a sudden, boom, the second they turn 18, they get, a fraction of whatever money's in the pot kind of a thing.
Right. A lot of people who are younger, who are selling investment properties, are leveling up and going to the next step and getting into larger multi or doing whatever they're wanting to do. But for most people, that's not the case all the time. There's a huge demographic of people who are selling a rental property just because they don't want to have a rental property anymore. And they have their home and they just want to take their cash and sit. And for those people, I think the issue that we've ran into, or at least I feel like that I've ran into, is not a lot of people know about this. Yeah. If this was common knowledge, if seller financing was just common knowledge and people knew how money worked and interest worked, and over time, the amount of actual money you can make by being the bank, a lot of people don't understand why banks are banks and how they make so much money. But you have the ability with that much equity to be a bank. So plus, a lot of people who might not know about this don't want to hear about it from a 24-year-old kid. And that's super fair. If I went my whole life, was very successful, and then some kid tells me about this funny money magic and how banks work, I'd be like, dude, get lost.
Just give me 500,000.
Just give me 500,000. Right. So, long story short, put the offers in, and it was 2 days after it was listed, and they went with another offer. I knew a couple other people who also put offers in on the same property, all lower than asking. So they might have just got a good conventional ask. And this property would honestly be a killer deal for anyone who this was their first time home buyer and could do the 5% down conventional rate. So if someone just happened to be in that situation, more power to them. It's a great property to do that at.
Yeah, if you can get in, if you get approved for that. I don't know if they're still doing that or what's good with that, but yeah, for how much money that property was pulling in, it seemed like definitely a cash cow for sure.
Yeah.
And the multiple offers thing was something we picked up from Bigger Pockets, where one of the guests, I'm forgetting right now which number the episode was, but he wanted to give the seller as many options as he could, and it would just phrase offers differently based on what options he had available. And
I honestly think it was Brandon Turner. Like, I think there was a guest on that he was talking to, but they were both like, saying how they both do it all the time. I know that he does it.
Yeah.
Like, it's just like, and not a lot of people think of that. Like, it's like, oh, you have one offer, but like, really, you're trying to meet the needs of the seller.
Mm-hmm.
Like, it's sales.
And they phrased it like, we'll deal with the trash in the basement, but for, $10,000 less on the listing price or something like that. Like, they were doing a little bit more specific, at least on their example, not like a whole different loan kind of thing. It's like, I'm guessing they're in a spot where they just have cash or whatever.
Right. So yeah, that's a good point. And that's like, but find your strength and like where you could add value to the seller, where you could alleviate a burden, like find out what the burden is, like what's that thing that they can't accomplish, and like how can you do it and how can you get paid to do it. Like making people's lives easier is like that's what money is. Like it's just like a monetary exchange for making something easier.
Yeah, that's the goal.
Yeah.
Just to make it a little bit better and just get money for it. We checked out some buildings. Was that yesterday or the day before? We were checking out 3 different properties, a triplex, 2 quads, and they're all really close to each other, all from the same seller. They were pretty expensive.
Super expensive.
Like crazy expensive. The cheapest one was, $450,000? The most expensive one was $600,000, like way up there. And we walked through all of them. The seller, like the tenants weren't all available to let people in. It was kind of like, it seemed a little schemy just because like they only showed us like the recently remodeled or like the obvious best units in the property, and they're like, you can't see anything else, just these ones. And
so there was 11 total units, and we were able to walk through 4 of them out of all of them. We were with we met another investor at the showings who we're friends with now. Shout out to Cody. And he was saying how like that's normal. Like he's been to a lot of investment properties and like not seeing all of them is part of it. And, personally, the 2 deals that I've been on, like I think we've been to maybe a couple that 1 or 2 units, like there might have been out of all these other properties, 1 or 2 units that I haven't seen. But like, how are you supposed to make an offer without seeing the building that you're making the offer on? Like the listing agent who was with us, she was like, yeah, just make your offer and then just make it contingent on seeing the unit. And it's like, well, why, you don't want to inconvenience the tenants every day. You have a new investor that wants to come in and see it. But like at the same time, you just got to let them know. And like, sorry, you're going to get inconvenienced. Like I'm selling the property that I own. Like I feel like that's only fair to the people who are interested in buying.
And it looked like they planned on doing this ahead of time too. Like they bought these a couple years ago with the intentions of flipping them, and that could have just been planned out a little bit better to have it available to see. Just because like the triplex was like we got to see 2 out of the 3, so we're at 66% of the building we got to look at. The one of the quads, actually 2 of the quads, we only got to see 1 unit.
Right.
So it's like 25% of the finished building. We got to see the basements, but like, the actual living parts, like, a quarter of it we got to actually look at and be like, yeah, submit an offer for $600,000, getting to see 25% of the building. Like that's crazy. That's nuts.
Right. So we just kind of wanted to like share what we saw in each of these, not like, if anyone's interested in going to see them, go see them, but we just kind of wanted to explain kind of our thought process going through these buildings and like if we thought they were a good deal or not. So,
and when we walk through them, we like to like videotape the walkthrough so that way we can run back and take a look. And I guess I didn't ask you this. Did you look back at any of the videos that you took?
No.
Anything?
I deleted all the videos because after I had Dylan go through all the work of writing up the numbers and just looking at the numbers, strictly the potential rent incomes for each of these places. And mind you, like they're all rented out. So any of these properties, even with the binder method is going to be a pain.
Yeah.
It's going to be a pain getting the rents up, and you might have to wait until if the moratorium is even lifted, because that's still a big scare of mine, even with the binder method, coming into a place that you just bought saying, hey, want you to pay more money, and then
They say no.
they say no and stop paying any money because they don't need to. That was kind of off-putting, and just the amount.
Yeah, the cost, like the monthly cost, like the cheapest one was with the FHA numbers you ran was just shy of $3,000 a month for the triplex. So pretty substantial. Like that's a lot of money.
Yeah, definitely a big chunk, and like for $3,000 a month is like it's serious money, and it's like of course all investments are, and like all mortgage payments are serious money, but like
we're talking like worst case scenario here. You're at 100% vacancy for whatever reason. Can you make that mortgage payment from like your job and everything else like that you got to pay? Like that's like an over leveraged scenario kind of a thing. Like
right, and so what we always talk about the reserves and making sure you have the reserves, and we were just talking about it this morning, but the way that I've been kind of thinking about it recently, because I've said it on the podcast before, like I make sure that I have enough money for if the roof goes bad, the heaters goes bad, the water heaters blow up, like all the big ticket items happen on the same day. Well, I have enough money to cover it, and that's what I want my reserve to be. After talking to Dylan the other week, he was like, yeah, like a lot of mortgage companies require, after you put your down payment down, will you have 6 months of mortgage payments, like principal, interest, taxes, insurance payments in your reserve, so, which honestly translated really well. So like, for my triplex, Pity's close to $2,000 a month times 6, $12,000 is what I should have in reserves for that property, which coincides pretty well with what my initial thought was. The Sourton one's close to $1,000, $6,000. For $3,000, that reserve that you should have is over $18,000, and it, like, based on the cash on cash that we've gotten with other deals compared to this, having that amount of reserves. So like with our cash on cash numbers, we put in for vacancy, we put in for CapEx, we put in for maintenance, and have that 25% of gross rent, right? So, but the reality is we're managing ourselves. We're doing a lot of work to make sure that it's not vacant. We're doing all these little maintenance items preemptively to avoid the cost later. So that 25% of gross rent a month should realistically be cash flow when you have the reserves to back it.
And it coincides with something I said before, where like doing a CapEx expenditure for each month as a percentage of your rent doesn't make sense when your rental income is like a few $1,000s a month, because it's going to take you a very long time to get to a point where you have enough to even pay for any capital expenditures doing that. So you have to have that upfront cash, and then the rest you can just keep as cash flow. Of course, if you take from your reserve, then you got to start replenishing it like with 100%. But we want to just use it as like a baseline going forward for all cash on cash calculations, is take that reserve, include it in the cash to close for the property. So that way it's, it's not like just some money like, oh, after the fact, after we run all these numbers, oh, by the way, you still need $18,000 to hold in the bank account,
right,
for this.
And they actually translate pretty well, like the cash on cash based on putting 25% or 25% of gross rent, or adding the 6 months in reserves to the initial cash and deleting the 25%. It's pretty similar. The numbers are pretty similar. So it just, for me, it makes more sense in my head. But anyway.
Yeah, it definitely, for what we're doing with how many units we have, I feel like it's the only way to do it, because, we just don't have enough volume to just take small percentages each month.
Right.
But
a lot of people also, like a lot of like bigger investors who have, 50, 100 units, they don't have 6 months in reserves for every single property, every single mortgage payment they have, because they know the likelihood of having to replace every single roof on all 50 of their units in the same year is very slim.
And that would be a lot of money to keep, like just sitting there doing nothing. Like,
right, but at this point for us, it's essential.
Yeah.
It's essential because we don't have 50 units. It very well could happen to 2 houses in 1 year.
Yeah, exactly. Yeah. So going forward, we checked out the triplex first, and that personally was my favorite out of them, just because just the way it was set up, the location it was at is right on the main strip and next to the businesses and stuff. I personally liked that one the most.
Yeah, me too.
It had a decent breakdown of the units, so 1 bed, 1 bath, a 4-bed, 1-bath, and then a 2-bed, 1-bath. So a good wide spread of options available. And then, of course, the garage in the back, which was actually really big and had 2 really nice classic cars that were pretty cool. But that one, with everything together, all 3 units plus the garage, we're looking at like $4,350 per month.
And that's
gross.
potential.
Potential, yeah.
That is not what they're collecting now.
Exactly.
Again, you'd have to make increases. And I believe the 4-bed, 1-bath, the tenant was moving out. So you could request that big chunk right now and get a year lease on that, which is great.
And that one definitely needed some work. Like the 4th bedroom, like it was like...
Yeah. You could tell the roof had been leaking at some point and really screwed up one of the rooms on the 3rd floor.
Big
but
time.
The other room on the other side of the 3rd floor was perfectly fine. It was
pristine,
so it would just be some drywall work, I'm assuming, if the leak is fixed. I don't think we ever got the answer back on that, but whatever. But so $4,350 in gross. Dylan ran the numbers for us. For all of these, we used the FHA. The FHA loan, 3.5% down, and I was running the numbers based on rolling my commission into the down payments, into the closing costs on each. So for this one, for me, it would have been close to $30,000 down. If for someone that didn't have their license, it'd be closer to $41,000 down. The monthly payments were $29.78, and that's principal, interest, tax, insurance. So pretty much $3,000. So if you lived in the 1-bed, 1-bath, which would be tough because they just signed a year lease with a new tenant, you could cash flow on this property $200 a month while you live there. But again, how are you supposed to do that?
Yeah,
it's almost impossible. They just signed a year lease. You could give them cash for keys. You could be like, hey, I'll buy you out of your lease. But it's really hard to find an apartment right now. They could say no.
They've probably been looking for the past like 6 months for an apartment, like find the perfect one. They just spent all this time moving in. You're like, hey, you trying to get out?
Give you $500.
Give you $500.
Yeah.
No shot. So that one's definitely gonna be tough. I mean, yeah. Say if you lived in the huge one, the 4-bed, 1-bath, because that's gonna be the vacant one. Like that's
right. I mean, you'd be paying what, $500 a month. Also, this is really important. We didn't factor in on the sheet that we have in front of us. Like we didn't put in. It's got one oil heater for the whole place. It's not zoned. So you're paying that oil bill. You're paying for water. You're paying for sewer. You're paying for trash. Those bills are a little less, but
it's still a couple $100.
Absolutely. So a few hundred. Yeah. Let's say 400 to be safe. And like, even with maintenance stuff, you gotta put some work in, but you get a really nice 4-bed, 1-bath unit that a family can live in, and you're paying $800 a month. I mean, it's not terrible for it, especially like, okay.
This is why we're saying it's expensive, just because like we're just trying so hard to like figure out a way to just make it even remotely profitable,
right?
To spend $30,000 or $40,000
right
on an investment. So like that's why it gets like challenging when the prices run up this high, because at the end of the day, you're still putting, without a commission for being your own agent, you're still putting $41,000 into an investment, and then trying to squeeze out like a couple $100 if you're lucky. Even after you move out, after paying all your utilities and all that kind of stuff that you got to pay, like it's
a big risk.
Yeah, it's expensive.
It's like if that one unit, like let's say you move out and that unit is vacant, you're losing money.
Yeah,
like that's I'm big on if one of the units is, I want one of the units to be able to be empty all the time and still be profitable, because that's like, I don't know. Which I guess you still would be if the 1-bed, 1-bath was vacant. It would still make sense, but there's just such a swing.
Yeah, the big one, the $1,700 unit went vacant. You're losing out on what, $400 per month if it's perfectly rented out everywhere else. I'm
just thinking about it now, but the triplex that I put that offer in with the one $2,000 a month unit, that was vacant for a couple months. I'd be losing money.
Yeah, big time. Well, I guess that's the other thing, is having like a set of like, say, one small unit and one big unit, or like, one small, one medium, one large. Like it doesn't evenly distribute the risk based on the vacancy like criteria. So like if you have this unit go vacant, you're just getting hit real hard, versus that one, it's like, okay, I'm still profitable. So maybe like the next one, it's a quadruplex with 4 single bed units.
And we got to see the one It was actually really nice. It was painted nice, and they had some Febreze sticks in the outlets. It
Yep.
smelled great.
And it was literally painted like the day before.
Yeah.
Like they still had the tarp in the closet. I saw like where they were just painting. Like you could probably see like the paint still wet on the wall or whatever. But yeah, it just seemed weird just how they set it up. You could see that one unit only, and it was the one unit they just fixed up.
Yep.
And it was just, yeah.
This was a big shocker to me. So like they just got a lease signed again. So for this one, there's one vacant unit that I was like, oh, can move in there. Nope. It's they have tenants coming in, and so this apartment, we walked in, it was like, where's the bedroom? It was, the kitchen was actually nice. It was like an old school, but it had character. It was a cool little kitchen, and then you walked into the next room, maybe a dining room, living room, and then you made a right, and there was another smaller room and a bathroom. And I was like, which would the bedroom be? And I think probably total this apartment was maybe 400 square feet, maybe.
It maybe a little, 400 seems a little small.
Maybe 5.
Possibly.
Maybe 5. And where we're at right now, we have a pretty small apartment, but it's probably 650, 700 square feet, and like man, this is small. I hope that we could get 1,100 for it. These guys are renting this tiny apartment for $10.50, I think. So it was like they were getting market rents, but again, like if you fully capitalized, got 1,100 for all 4 units, it's $4,400 a month. Based on that 1% rule, you're nowhere close to 550,000.
Yeah, 550,000 for this place just seemed like astronomically expensive, and like it had a garage, yeah, but like,
oh right, I didn't see. So yeah, an extra $200.
Yeah, extra $200. Like, yeah, you're talking $4,600 a month gross coming in, and it had some features to it. Like it looked like they just updated all the electric, which was nice, but the furnaces were definitely
It was, again, one big old oil
Old,
furnace.
yeah, real old one.
So you're paying the oil heat again for the entire building, water, sewer, trash. It's the principal, interest, taxes, and insurance were like, what's that? 33.63.
Yep.
So add 300, and you're
the net income was $1,237, without paying utilities. So whatever those come out to be with, water, sewer, trash, and oil, you could be looking at a lot less. Like that's even renting the entire place out.
Right. And that's this one without, getting any cash back for having a real estate license, 45,000 down for barely 900 in cash flow. And that's not even like real cash flow. That's not considering the reserves. That's not considering like it's very low.
Yeah.
And didn't seem like a really
like
exciting deal.
If you just walked into this place with an FHA and this is your first time buying a house, you'd be looking at dropping $45,000 just to get the place. And that's just the down payment though, right?
Yep.
Not the closing costs.
No, that's the closing cost also.
Okay, cash to close, got you. And then you got to look at any repairs because we only got to see one single unit.
Right.
The freshly, we could be looking at, other water damage in the other one, like,
right.
Like we saw before.
And again, on all 3 of these units, none of them would pass FHA. Yeah. Not a single one with the condition they were in. They would all be fine, like conventional, to buy as an investment property. You'd have no problem. There's, in most houses, any older house, all these places are older, built in early 1900s. You're gonna have like some peeling paint somewhere. It's not the end of the world. But for FHA, it is. They have a lot of, like we've said a million times, like a lot of stricter guidelines. And like, so this, you'd still have a ton of work to put in. You'd probably need a 2 or 3K loan. Like it. And then if you were doing it conventionally, like if you weren't living here, putting 25% down, your cash on cash would be nothing. Like, can you imagine putting over $120,000 down on this property and making netting after everything's said and done less than $900?
Nuts.
That sucks.
Yeah.
And it's like, but people are still buying them, so I think, we'll go through the last one, but the moral of the story is, all 3 of these came up. They're the same seller. They listed all of them, this week. So it was like, there's no wiggle room. There's no advantage to the buyer when it's been up for a day. The market doesn't lie. Like a house is worth what someone will pay for it. So if this place is up for 3 months and the highest offer they get is $400,000 on this, it's worth $400,000, and then they can choose to sell it or not. And
if they put it up for 600 and it closes in a week for 600, it's
worth 600.
It's apparently worth 600. So.
Right. So we'll find out. I'm definitely curious. I'm going to keep my eye on all of these properties to, in 2 months when they don't sell, because I don't think they will. I think the triplex will.
Yeah.
I don't think the other 2 4 units will. And
we're kind of just gauging to see what the mania is right now, because like, what can you do to make these places profitable? Like, unless you're just buying it to capitalize on, hopeful appreciation to just sell it again for 700,000,
which is like, this is the worst time. It's like, oh, Bitcoin just hit 60,000. I'm gonna buy a bunch. Like, it's
buy the top, sell the bottom.
Right. Like,
the quickest way.
We have so many people, I think, investing right now in the fear of missing out, the FOMO. Like, it was funny. Kayla was asking me kind of, because I told her about these properties, and she's like, are you putting any offers in? I told her how much they all were, and she's like, dang, like, how long do you think the market's going to stay like this? And it's like, I don't know. And she's like, well, what do people in like bigger pockets think? And it's like, it's so spread out. We've got people who, like, most of the tenured, for real investors are selling their properties right now. They sell at the top and they buy at the bottom, and they keep it going that way. So a lot of those guys are saying, you're an idiot if you're buying right now. These are so high. Then you've got the people who are saying, well, if the numbers work, real estate over time always goes up. Like, if the numbers work now, buy it. And there's some people who are like, also, I might not have the opportunity, like, in 2 years, this place could be worth $1 million. Like, people who are just scared of missing out on that train. And it's like, they might not be wrong. They might be right. People might buy it at 600,000 and sell it in 2 years for $1 million. But the reason why I don't think that's going to happen is because rent prices don't just skyrocket the way that house prices do. They stay consistent. And for investment properties, an investor isn't going to take on all this responsibility for
free.
For free. Why would you do that? So, like, I don't know. I think it's a tough call, but I really think, and I think Caleb agrees with me, if the numbers work, you're not an idiot if you buy 30,000 over asking. That doesn't make it a bad deal. The purchase price doesn't mean anything. What's your monthly payment? What's your down payment? And what's your rental income? Like, those are the only 3 things that matter. The list price, it doesn't mean anything.
It's like the least important factor of the calculation is just what the list price is, because you're leveraging it with a loan. So it's like, there's, that's just such a small piece of it. There's all these other factors. Like, your interest rate is more important than the list price. You know what I'm saying?
Right.
Like, just because that just makes that list price more expensive. It multiplies how expensive that is. So yeah, you got to just factor in everything. You can't just look at a place and be like, 600,000, that's crazy. Sometimes you can, like this place, we just ran the numbers. Like, that is literally crazy. Like, you can't make that much money back from how expensive it is. But other times, if you're looking at jumping in now and you think it's too expensive, just run the numbers. If they make sense, you're not crazy buying it right now. Sure, like, maybe in a few years we might see a slight dip in the crazy appreciation we're seeing now.
Or a crazy dip too.
Yeah, or a crazy dip.
But if the rent stays the same.
Yeah, the rents stay the same. But say 20 years from now, this is all completely meaningless.
Yep. And I think a lot of people forget about that. And like, I was just having this conversation in the barbershop today. Like, oh, dude, I would never put 30,000 over. And I was trying to explain to the guys, like, look, 30,000 over asking with a 3% interest rate is much better than $100,000 under asking price with a 10% interest rate. It changes so much. And like, that's what a lot of people are hoping for, is this smaller list price so that their ego feels good. Like, oh yeah, I got this place cheap. You paid that much? Like,
idiot.
And it's like, that's not the case, because if it all just matters about what your numbers are, what's the interest rate, what's the actual monthly payments that you're required to make every month compared to the income.
And that's why we go with cash on cash so much, is just because it's like such a clean cut. Like, how long does it take for this to pay back my initial investment. And it's just like comparable against other units. You can look at one property and then, we keep learning more as we're doing it, like how to calculate it better. But like at the end of the day, it's still a rough calculation. It's not like, the Bible on what's the best deal you could ever find, but it definitely helps. And it let us see, like, for this last property, the $600,000 quad, we were talking $4,700 coming in gross revenue from
after things were adjusted and increased.
Yeah.
Like
after, like, seeing like this is like using the rents that we charge for our units after we fix them up, we would get, $4,700 a month. Granted, you're most likely going to be way under that buying this place because it's all rented out. The owners of this place were just adamant on renting it out. They didn't want any vacancy, even when selling, which can be kind of tricky. But
yeah,
the one thing that was good, though, they had a new gas furnace. So
4 gas furnaces.
Yeah, 4.
So all the tenants paid their own gas bills and paid their own heat, which alleviates a big expense. And when I was just like roughly thinking about the properties when we left, I was like, I don't know, I kind of like that one. But then after seeing this, it's like, dude,
yeah, you're still looking
sucks.
at, if you have a license and you can buy it yourself, get your commission in there, you're looking at $35,000 cash to close. If you don't have your license, you're looking at $50,000 cash to close, and then a whopping almost $3,700 monthly bill for the house of like your principal, interest, taxes, and insurance. So your net income, this is with market rents, with fully rented out, you not even living there, your net income's $1,000 a month.
right.
For putting $50,000 into this place, you're getting $1,000 back a month, which isn't
including reserves, which isn't including the rehab. Like, and this is with the FHA loan that no seller wants to see. So like, this is like the best possible hypothetical we're making that wouldn't get accepted, and like
it still doesn't make sense.
Doesn't make sense. Like I'm running the numbers right now. Like 50,000. We've got, okay, I'll just do $1,000 a month, even though it's going to be less than that. It's 12,000 a year divided by 50,000. That's actually good. It's 24%, but it's still
24%. Yeah.
With the reserves that we're talking about, having 6 months of $3,700, that's another $20,000. That's 70 plus the rehab. Let's call it 80. $80,000 divided by $1,000 a month, or
having that monthly bill of 6 months is like $22,200. So that would be $72,000 for your cash to close. That you'd be calculating that by the 12,000. It'd be a lot less than 24%.
Yeah, I just ran it again on $80,000 purchase price, $12,000 a year in income. And it's 15% cash on cash, which is like...
Maybe we're wrong. Maybe we should just be, blowing on these $600,000 houses.
But remember what we were saying about this is still with only putting 3.5% down. You have no skin in the game here.
Yeah.
Because you're sacrificing a year of your life to get 15%. Where like if you did 25%,
a lot more money down. For sure. And like this is granted, like we were saying before, the FHA still wouldn't even fly these places. We're walking through the basement and
it had a river.
It had a river running,
like an actual river.
Like super old style drain system with running water through the bottom of this basement, and the knobs for knob and tube wiring just everywhere in that basement, just completely full of knobs. Like any inspector walks in there, they just have a heart attack. They just like write it off right away. Like, no shot this place is getting insurance.
Okay, so now I ran it as an investment, so 25% down plus closing costs plus a little bit of rehab, $170,000 out of pocket for $12,000 a year in income puts you at a 7% cash on cash. Not good.
Yeah, I mean you're beating inflation by a little bit. That's
so
like the S&P 500 if you just bought that. Save yourself some time. Just buy some stocks.
Right. So, I mean, again, like it's not the worst, and maybe we're just idiots and we got lucky in a good market, and now real estate investing isn't going to be as glamorous from now on.
Yeah,
I don't think that's going to be the case. I think it's going to blow over, and there's still going to be deals to be had.
I just want cheap duplexes, man.
Just give me cheap duplexes.
That's it. That's all I want. Some cheap dupes and just live in one half, fix out the other, just rinse and repeat. That's all I want.
Hey, I think that's fair. I think that's definitely something.
That reminded me though, like that thing you brought up from talking to the lads at the barbershop about buying a house that keeps you locked into an area. And you brought up a good point that I just never thought about it before. But when you sign a lease for an apartment, you are actually locked in, like contractually locked into that property for a minimum of like whatever, a year, whatever your lease is for. But if you buy a property, once you get it, it's yours. Like you can just do what you want. Like you're not like locked into doing anything specific. Whereas like with a lease, like you got to either buy yourself out of it, which could be a lot of money to get out of it, versus with a house, you can either just pop it back up in the market, rent it out, or just leave it, just come back to it later. You can literally do anything.
Right. And so we're having this conversation in the barbershop, and we're, talking like, the guys are saying, yeah, like I just don't know, like in a couple years we might be moving. Like I just don't want to be totally locked into this area. And it's like all that stuff that Caleb was saying is super, super valid. It's like, dude, you're more locked in a rental than you are with buying. And during the time of you renting, you are throwing your money away. Or not throwing it away, you're trading it for a service, but at the same time, you're making your landlord richer while you are not. And, renting's definitely not always a bad thing. Like having car payments is not necessarily a bad thing. Buying a new refrigerator is not necessarily a bad thing, but they're liabilities. And just knowing the difference, knowing that hey, this thing that I'm putting my money into is not making me money. And by knowing the difference, it was funny. I had this conversation with Danny, and he's like, his big thing was like, protect your investment, get your car washed or whatever. And I was like, dude, it's not an investment. And he's like, yes, it is. Like, you need a car. And it's like, well, you don't, though. But, you do, but it's a liability. As long as you can recognize that it's a liability, it's not an investment. It's not making you money, but it is something that's necessary. And we all have those things.
I guess technically, he's got a point, though. You can't, say, for me, I don't need a car because I work from home. But if you have to commute, technically you wouldn't be able to make money without the car. Because say if you got an Uber to work, think about you got an hour commute.
Mm-hmm.
Think, what would your Uber bill be?
A lot
of money.
But it's not so is your refrigerator an investment because it keeps the food that you buy at the grocery store cold, and now you don't need to go to the grocery store every single day? Is it an investment because it saves you time? No. Do you think it is?
It could possibly be looked at that way, because think about it. Say if everyone was just used to driving to the grocery store every single day to buy your food, and if you didn't eat it that day, you gotta throw it out. And somebody came around yo, man, I got this cool thing called a fridge. It's a cool investment. You buy it, you put it in your kitchen,
and it saves you all this money.
It saves you all this money.
Huh.
So, technically, it would be. It's such a cultural aspect now that we just think of it as a liability, because if you don't have a fridge, you're a crazy person.
So Danny was kind of on your side. I'm on my side. We did the poll on Instagram too, and more of our people that are on Instagram said cars aren't liabilities. Shout out to all you guys, because you're on my side. But anyway, we're having the same conversation. I'm like, well, what do you define as an investment? And it's does it make you money?
That's the part right there. I think that is where the gray area comes, is what is defined as making you money, because
saving you money is kind of making you money.
Exactly. At the end of the day. So you can make an argument for anything saving you money is making, you know what I'm saying? It could.
So I guess my perspective on it was I'm minimizing my costs on this thing that doesn't produce income for me, which I guess the way that you're phrasing it, it kind of does, because I have to go to work, and I know Danny's going to listen to this and be like, Jake, you're an idiot, I told you. But it's a depreciating asset. All these things are, which I guess
everything
your house is too.
Shit.
Damn.
Got him.
Maybe. All right, whatever. Don't buy houses. Just buy really expensive cars and really nice fridges. and
That's all you need.
rent forever.
Yep.
Yeah, because okay, so is rent an investment? Because without it, without a roof over your head, you'd be sleeping outside.
And I guess like...
And all of your stuff would get wet. You wouldn't have a fridge. You'd have to go to the grocery store every day.
Yep.
You know, you couldn't do your laundry. You'd have to go to the laundromat. Like,
I guess if you compared being homeless to living in a rental, you know, the peace of mind of having a place to put all your things would technically save you money having it in a rental versus like, you know, in a box outside.
Right. So yeah, rent. Don't ever buy rent, lease cars,
Yep. Heard it
and
first.
Just work until you're 65, you know.
Yep, because you're saving money. At the
you're
end of the day, like, you are saving money.
Well, I feel like we should delete this episode.
Nope, it's going out.
No, it's an interesting way to put it, because like I feel like that's something that I've been very adamant in the opposite direction about, like, since I started learning about financial independence. And it's like anyone who is financially independent will tell you minimize your expenses on things like rent and a car, or buy an asset that is going to make the payments for your car, your rent, or whatever it is.
I mean, I could explain to you, like, where you're coming from is the rich dad, poor dad definition of an asset, which is income generating, not loss aversion. So, like,
right,
if you're looking at everything as loss aversion, you can, you know, make some bad decisions. But, like, if you focus all of your effort onto just building yourself up through, you know, creating that income snowball with assets with actual generation of income, not, you know, loss of spent money, it's just, it'll actually grow versus just keep what you have more.
Right. And I think that what makes people successful is that mindset of income generation. An asset is something that brings an income, not the safety net of like,
I don't want to lose what I have.
Yes.
Yeah.
So no, I think that's a really good point. I feel like I got away from it. But so when we were talking about you want to get out, and having a property manager is like a for real option. You know, there's more risk involved, of course, but like selling your property, like you were saying, renting it out long term, you know, it's a much more freeing thing. And if it's able to pay your rent where you go decide to move, that's great. Or if it buys you a house where you go decide to move and pays the mortgage payments there, great. And then you can keep doing that. So I think, like, I don't know, part of the I guess moral of the episode is like, this is what the market is showing, and just because, you know, something's listed at something's available doesn't make it a good deal. And I think that's pretty common knowledge, but it's like, you know, we went into these places like, you know, maybe there's going to be some good opportunity here, especially with an FHA low down payment, like, but it really isn't. And I think it's going to come down to these properties sitting for a couple months.
Yeah, if they sell really fast, like, that's gonna be rough.
If they sell really fast, we have to start looking
We're gonna
elsewhere.
start buying stocks, dude.
or just real estate somewhere else. You know, the places that we've been skeptical of in, you know, Norristown and Pottstown, like,
big time.
That because if people are buying, so you got to think about this. If people are paying this, you know, quickly within a week, that means in order for them to make any money, rent's got to go up, like, significantly. What happens when rent goes up in a town where the median income is X? You know what I mean? You got to move. So where are people going to move to? The next closest city where rent's cheaper. Yeah, so I don't know.
There's not that many places to rent in Souderton where these places were.
Right.
Not too many like, it's not a big town.
Right.
And this is like 11 rentals, you know,
right.
all astronomically priced.
Right. So all of a sudden, 11 out of, what do you think? There's probably like 2,000, a few thousand. Yeah. Like, it's a fraction of a percent, but still, like, if this trend catches on, if other landlords start seeing, oh, wow, this quadruplex that I bought 5 years ago for $300,000 is selling for $600,000, you sell. You know, that's the time to sell. You just made, you know, a bunch of income on cash flow, and now you can get a big capital gains. And it's like, if this does catch wind, it's going to be a movement in Souderton where, like, if you're not already in, it's not worth getting in. Or, you know, rents all just double and more rich people move to Souderton. I don't know. What do you think? What do you think would happen if this catches on and everyone just doubles the rent? What would happen?
Well, like you said the first time, if the median, rent in the area starts going up astronomically, and it's a trend that everyone else, all the other landlords started seeing that, their $300-$400 a month rents are now 4x. They're gonna see how much money they're missing out, either selling or jacking up their rents. So your only other options are moving in areas which have the lower cost to them, which would be, like you said, the Norristown, the Pottstown areas, and
Then what happens to Norristown and Pottstown when there's this huge influx there? Like, where do they go?
Philly's cheap right now. So,
is it?
Yeah. I mean, at least from what I saw, some stuff, like, there's so much stuff for sale in Philly. It's crazy. Like, just how many, like, places you can buy.
Right. I mean, we did just see a huge influx of a lot of big earners leave the city in the last year. Like, with the lockdown and stuff, it was not the place to be. So a lot of people left. That's part of why the market's the way that it is. And I kind of wanted to talk about that too, because, like, why people are like, oh yeah, it's 2008, there's going to be this big crash. And it's like, it's very different than 2008.
Big time. Yeah. I mean, it's like the complete opposite of 2008, because you have, in '08, you had people, fog and mirrors was the criteria required to get a loan. Like, as long as you breathed, you could get a loan. Nowadays, you have, your debt to income ratio has to be under 45%. That's huge.
Right.
So you can't get like 6 loans. You can only get one that meets 45%. Like, cost of it is 45% of how much you make per month, which is super limiting. And then also, like, how much cash you have available and what your credit is, all this stuff limits so many people from buying houses doing it this way with all these criteria. And then on top of people having stricter criteria to buy a house now, the supply is super low. People are, lining up like crazy, submitting all these way over asking offers for this super small set of available places that we have for sale. So it's like the complete opposite, where you had before, everyone was getting as many houses as they can get. Nowadays, you have everyone fighting over what little houses are available, and it's like
right.
A supply
And I mean,
shortage.
you've also got a lot of guys who capitalized in 2008, bought low, are holding a lot because they're producing great. So you've got a lot of people who are in that position of already holding or bought before we got to this point and are holding, and now they have the income generated from their buys in 2008 or from 5 years ago, and now they're able to buy lots of more properties. Like, it was easier then for the average Joe to buy multiple properties. Now it's tougher.
And, like, at the same time, the reason why 2008 happened was the financial regulations put in place that keep that from happening were removed like 10 years prior. In the late 90s, Bill Clinton pulled those regulations away to, like, stimulate the economy, to get some more money flowing, so we could beat, like, the Japanese or whatever. And all of a sudden 10 years later, the mortgage-backed security, like, market is just going absolutely crazy, and they're just, like, printing money. They're like, this party can't end, and then boom.
Right, but and at the same time, like,
right now,
all of those loans that they were offering were all adjustable rate mortgages.
Not all of them.
A lot of them were.
A lot of them were, and, like, you could just look at them. Like, nowadays, when we're going through our paperwork, they have all that criteria the underwriter has to hit before they can put the loan on the open market to get picked up. Like, he was saying that Dylan was mentioning that nobody was buying the sub 3 interest rate loans besides the government.
Right.
And, like, it's just, I think it's a big, like, indicator that we're not looking at a financial crisis causing this mortgage issue right now. It's just like a similar situation to, like, say, the supply chain problem we're seeing with lumber or other materials going on right now.
But
computer parts.
What do you see at, like, I get it, the government's buying up all these mortgages.
Well, they did, not too much now.
Okay, so they did that for what, a year?
I don't know the exact time. Right?
Yeah,
I remember seeing that.
Whatever it was, like, they're buying it up, they're stimulating the economy, and it brought interest rates down. Okay, for 30 days it's sub 2s, and then it's back to normal. It decreased down, got to the bottom, and went back up. And it's slow. It's a slow and steady, gradual process.
It's almost like they took the gas pedal of their money machine and just like kind of pushed it down a little bit.
Yep.
And the rate just kind of like dipped down because they scooped up a bunch of super low interest rate loans, and then they let back on the gas pedal, and then it slowly moved back up again as the rest of the private banks were scooping up afterwards.
Right. So I don't think we're necessarily seeing a big crash coming, but we are going to see interest rates probably come back up some, which is going to limit people's ability to buy. But is it actually, like, are we going to see in 3 years, like, people failing to pay their mortgages? Like, they have fixed rate mortgages. You know what I mean? Like, if they can afford it now, what's going to hold them back from affording it 10 years from now?
Yeah, I mean, that's the biggest question, I think, is like, how bad is the economy actually? Because we got so much camouflage on over reality from all the stimmies we got. And like, are people actually like lined up at the door ready to hit like eviction? Or is it overhyped by the media that, you know, the economy's in shambles, when in reality, like, we all were okay after, you know, a couple weeks off initially and then just staying home for a while.
Right.
I think the restaurants took it the worst, the movie theaters for sure, but like,
yeah, like there was definitely a for real percentage of people that struggled. Their means of making money was stopped.
And they just filled it back up with the unemployment that people were getting, and that's still happening now. Like, people are still having trouble getting workers.
Right.
You know, and like, I think the only place that really makes like a big issue, I'm sure, is like the farming industry. Like, if you can't get people working on the farms, you may get food shortages, and then that'll affect everybody because prices will increase.
Yeah, weren't you just saying there's a chicken wing shortage?
Yeah, the chicken wing shortage, yeah.
What's the deal with that, dude? I haven't heard anything about that.
Yeah, like, they were apparently, Tyson Farms or other chicken plants around the area were making it all, were just having supply chain issues, and they weren't able to get it out, and all these restaurants around here were just charging
because the restaurants are all reopening.
I could definitely be that as well. Like, the supply, like the demand was
just
so
increased
low that it just jumped up super high, and they had to ramp up production again, because production is definitely a lagging indicator. But like, yeah, they some restaurants were charging like $65 for a plate of wings because they were so hard to get.
What?
Yeah.
When was this?
This is like this past week. It's crazy.
I don't know where I've been, dude.
Getting flats instead of
yeah, dude. I'm the big flat guy. I'll order all flats. People hate me, and then everyone else who gets me
take all the drums out,
and then the people next to me get all the legs. But yeah, we're gonna do a little poll on Instagram after this episode comes out, and if you like flats or
drums,
flats or drums.
Yeah, but I think that there's just so many other pieces to it that, like, real estate is just one aspect of the supply issue we got going on here, because we've never had a shutdown before of the economy. You know, think something crazy as like a world war happens, we still just ramp that puppy up. You know, we never shut it down before. So there's nothing we could look back on history and be like, yeah, when was the last time we just turned it off?
Right. Yeah, so we'll leave you guys with that thought. And honestly, what we're taking, or what I'm personally taking into a much like bigger consideration is, you know, considering that second home, that vacation loan, that out of state investment property. You know, it's, if the numbers work, you know, the due diligence is so important, and there's a lot of resources, and I'm not totally fluent. Like, there's a lot of research that I've got to do if this is something I really want to pursue. But it's like, get creative. Like, if you have this fire ignited for finding financial independence, you know, no matter what the real estate market is doing, should not limit you in doing that. So whether it's,
don't let it discourage you. Like, there's so many other ways to make money.
Right.
You just got to get creative with means of, you know, expanding your income snowball and, you know, get that puppy rolling.
Start a business. There's such a demand for people who go to work.
Yeah.
Like, it's such a hard thing to find a contractor who will show up on time. I was just telling a couple friends, like, if you do carpentry, you can make $100,000 a year here.
Yeah.
Like, side work. There are so many people who can't even find subs. There are people turning down millions of dollars of work this year because they don't have the employees, and they can't even find actual subcontractors, like other people who actually know what they're doing, to come in and do the work at a higher rate. Like, it's like, people are waiting. Like people aren't able to get their jobs done. Like there's such a demand for anything trade related right now that like even if you don't know a trade, like they're not rocket science. Like there's so much. I have so much respect for tradesmen. I work in the trades, blah blah blah. But like if you have just like a brain and like access to YouTube
and some time,
like it's a real option. So like, you know, use this opportunity, hoard cash, put it into something that will make you money, whatever it is. Is it a food truck? Is it a
gumball machine?
Gumball machines? Is it I was just looking at an RV on Facebook Marketplace for $4,500, and it's like, you know, I could put another $5,000 into that, get it really nice, and you know, on Outdoorsy near us, you know, nice RVs are renting for $250 a night. I get a not as nice one, rent it for $100 a night. Like $100 a night is a crap ton of money off of 10 grand. You know what I mean? Like think outside of the box. Like I know we're trying to give on this podcast like the ideas of what we're doing, what we're thinking, but like there's so many more other things. Like there is so many ways to become successful. It's just like don't let what's going on discourage you. Like everyone can eat, you know.
You can always find a way. You just gotta put that thinking cap on and you'll get it done.
That's right. So all right, and with that, we'll see y'all next week. Peace.
Yeah. Peace.